Alright guys, welcome to the online class on derivatives, futures, forwards and options by Finstructor Mumbai. Enrolled students must have received a question bank of over 3,500 plus questions. Practice is the key to success on the exam. Please practice as many questions as you can. My name is Aditya Aluwalia. Call me on the number or email me for any doubts or conceptual queries that you may have after the class. Visit us on the website or email us at info@finstructor.in for any queries regarding admission, etc. Now at level 1, we studied how different derivative instruments worked. So what a forward is, what is a future, how do swap contracts take place in different currencies. At level 2, we will study the valuations of each of these instruments and see how the value changes as the market prices fluctuate. So let's dive right into it, and let's revise what a forward contract is, and let's try to put a price to a forward. Now, a forward contract is an agreement to exchange a particular asset at a pre-decided rate at a pre-decided time. The buyer of the asset is said to be long the forward, and the seller of the asset is said to be short the forward. Now the question is, what is the pre-decided price that the buyer and the seller will agree upon in a forward instrument or in a forward agreement? So let's start. Assume a stock is currently priced at a value of S. You can even call it S0. And we need to determine the fair forwards price at a time t from now. So this is t equals to 0, and this is, let's say, t equals t. So two counterparties are getting into an agreement to exchange this asset at a price of f at a time t from now. The question is, what is the fair f that the buyer and seller will agree upon? Now let's look at it from the buyer's perspective. As the buyer of the security in the forward market, I have two options. So I am buying it in the forward, so the agreement is to pay f and buy the asset at a time t equal to t from now. Why am I choosing to buy the asset in the forward? I am positive on the price, however I don't have the money right now. So what can I do otherwise? If I don't have the money right now, rather than buying the forward in the derivative contract, I can borrow money from a bank and buy the asset today itself, and at a time t equal to t, return the money. So the buyer has two options. First is enter forward. If he enters the forward, what is the cash exchange right now at t equal to 0? At t equal to 0, what is the cash that the buyer or the seller will have to pay? So the agreement is that at a time t equal to t, I will gain the asset and pay a price of f. So at t equal to t, I will pay f and gain the asset. That's what the buyer can do by entering the forward contract. So there will be no upfront payment. However, at maturity, he'll have to pay f to acquire the asset. What is the second option that the buyer has? Borrow and buy now. The second option is borrow the money and buy the asset right now. If he goes for that, what is the upfront payment that he'll have to make, or what is the money that he'll have to shell out right now? The current price of the asset is S0. So he will have to sell S0 right now, or rather he'll have to borrow S0 right now, pay it to the market and receive the asset. However, if he borrows S0 and buys the asset right now, how much will he have to pay back at time t equal to t? S0 into 1 plus r raised to the power t, or if you are doing continuous compounding, S0 into e raised to the power rt. So if he goes for the second method, then at time t equal to t, he will still have the asset. So here he borrowed S0, he paid it and he acquired the asset. So he will still have the asset with him. However, he will have to pay the bank S0 e raised to the power rt, or S0 into 1 plus r raised to the power t. So the buyer is in benefit, or the buyer will enter the forward contract if and only if the forward price is less than or equal to S0 e raised to the power rt. So if the forward price is anything greater than this, then the buyer has no interest in entering the forward, because he can simply borrow the money and pay the bank back at the time t equal to t. So to enter the forward, you have to have the forward price less than or equal to S0 e raised to power rt. Now let's look at the seller's perspective once. If I am the seller, what will I think? I have two options. Either enter the forward and sell the asset later, because I don't want to sell it right now. I'll sell it at a time t equal to t. If I enter the forward, what is the payment that I will receive right now at t equal to 0? A forward agreement is an agreement to exchange the asset at a price of f at a time t equal to t. So what is it that I'm going to change, or what is it that I'm going to pay today? Nothing. How much will I pay or receive at the time t equal to t? I will receive f, but I will have to deliver the asset. The second option that I have is to sell right away. If I still sell right away, how much will I receive? The current price is S0 and I give up the asset. So then how will the things look like at t equal to t? I have still lost the asset, but my S0 would have become S0 into 1 plus r raised to power t, or S0 e raised to power t using continuous compounding. Now, if f is anything less than or equal to s e raised to power rt, the seller would not enter this contract. Seller is anyways getting S0 e raised to power rt by selling the asset right away. So the seller will always demand a price of f which is greater than or equal to S0 e raised to power rt. However, will a buyer be interested at this price? If the price is greater than this, the buyer can simply borrow from a bank and purchase the asset. He does not need to enter the forward. So the only price at which both the buyer and the seller will be comfortable is when f is equal to S0 e raised to the power rt. Now a lot of people think that it's just the future value of s. Yes, it comes out to be the future value of s. But please understand that this is the no arbitrage price of the forward. So regardless of what the expectations of the stock or the asset are, the forward price will just be dependent on the current stock price and the interest rate and the time to maturity and nothing else, because that is the no arbitrage price. If the price is any different, then there will be an arbitrage opportunity, as you will understand once we do the examples on this topic. Now before we move on, same question. The stock now pays a dividend D at a pre-decided time t equal to t1. So the stock is valued at S0. At time t equal to t1 it will pay a dividend of D, and at time t equal to t is where you are entering the forward. Question now is that what will be the fair price of the forward now? Given S0, given the interest rate R, and given T1. D is the dividend payment. Let's look at any one perspective again. Please try to derive the other perspective yourself. So we can either look at the seller's perspective or the buyer's perspective to understand this. So let's see from the seller's side. Now seller has two options. One is enter the forward, and the second is sell right away. If he enters the forward, what will be his cash flow at t equal to 0? Nothing. Remember, the dividend is paid to the owner of the stock. So whoever is owning the stock at a particular point in time is the person who will be entitled to receive the dividend payments. So at t equals to t1, if the seller has entered the forward, will he receive a dividend payment of D? So he receives a dividend payment of D, and at t equal to t, what is going to happen? His D would have compounded to e raised to the power r t minus t1, or 1 plus r raised to the power t minus t1, because this is the period that dividend has been invested for. There would be a payment of F, and he would have had to sell out the asset. So he would receive a payment of F from the forward, but he would have to sell out the asset because he has entered the forward contract. So this is how the things will look like if he enters the forward contract. Similarly, if he sells the asset right away, what is the cash flow that will happen at t equal to 0? He will receive S0, but he would have given up the asset. At t equal to t1, will he get the dividend? No, because he has already sold the asset. So at t equal to t1, no more dividend. So at t equal to t, how will things look like? The asset is still gone, nothing can be done about that. However, I have received S0, which would have compounded up to S0 e raised to power RT. Now, the cash flows from the forward contract have to be greater than the right or the upfront sale for me to enter the forward contract. Otherwise, there is no benefit for me. So, D into E raised to the power R into T minus T1 plus F is what I effectively have to pay for this asset, must be greater than or equal to S0 e raised to the power RT. S0 e raised to the power RT is what I'm getting if I sell right away. So what should F be greater than or equal to? It should be greater than or equal to S0 e raised to the power RT minus D e raised to the power R T minus T1, or you can take e raised to the power RT common from here, so e raised to the power RT into S0 minus D e raised to the power RT will come out common, only thing remaining will be minus RT1. So please remember this formula. It is S0 minus the present value of the dividend payment into e raised to the power RT. Now in the exam, You will not have the time to derive it like this every time. Similarly, you can do the buyer's perspective and you'll see that F has to come out to be less than or equal to. The only price that the buyer and the seller will agree on is when F is exactly equal to S0 minus the present value of dividend into e raised to the power RT. So, in all formulae involving derivatives, whenever the stock is a dividend paying stock, replace S with the present value of S, or replace S with S minus the present value of the dividend payment. Now in a lot of cases, dividend payment will be given as a continuously compounded dividend yield. So stock pays a continuously compounded dividend yield of R star. In that case, replace S with S0 e raised to power minus R star T, where R star is the continuously compounded dividend yield. We'll do some questions and understand this better. So whenever the stock is dividend paying, replace S with S minus the present value of dividends. Consider a 3-month forward contract on a zero coupon bond with a face value of $1,000 that is currently quoted at 500, and assume a risk-free annual interest rate of 6%. Determine the price of the forward contract under the no arbitrage principle. So this is currently quoted at 500. So what is S0? Okay, it may be a bond, it may be a stock, it may be a commodity. You can value it in exactly the same way that we just did. So S0 is 500. The rate of interest is 6%. Is there any dividend coming from this stock? It's a zero coupon bond, so there's no coupon payment, so there's no cash flows coming from this bond at any point. So what is the price? Assume annual compounding. So annual rate is 6%, and we want to value a 3-month forward contract. So the 3 months will be S0 into 1 plus R raised to the power T. T will be given by 3 by 12. So if unspecified, use annual compounding. If specified, you can use continuous compounding. So the no arbitrage forward price comes out to be 507.34. In our 3-month zero coupon bond contract example, we determined that the no arbitrage forward price was 507.34. Now suppose that after 2 months, the spot price on the zero coupon bond is 515 and the risk rate is still 6%. Calculate the value of the long and short positions in the forward contract. Now guys, this is very interesting. So we entered into a 3-month contract. At t equal to 0, the price was $500. The contract was till t equal to 3. The contract was that at t equal to 3, the buyer will buy the asset and the seller will sell the asset for a price of 507.34. Okay, approximately 507. Now this 507 was decided at this point when the price of the bond was 500. At t equal to 2. So 2 months later we found out that the stock price is 515. who seems to be winning now? Is the long party winning or is the short party winning? So the long will purchase the asset at 507. The long seems to be winning because the stock price or the price is moving up. So he will buy at 507 and he will be able to sell it at a higher price. Now, but how much is he winning by, or what is the cash flow or the value realized if he chooses to exit the contract right now? If he chooses to exit the contract right now, at t equal to 0, he is long at the price of 507. At t equal to 0, he can short the contract at the fair forward price right now. So what will be the fair forward price right now? Now this contract is now expiring in 1 month. So the fair forward price at t equal to 2, which we'll call F1, would be equal to 515 into 1 plus 0.06 raised to the power 1 by 12. So he will short the contract, or he will short the asset at F1. Now let's see what will happen at t equal to 3. Because of the first contract, at t equal to 3, he will have to pay $507 and purchase the asset. But because of the second contract that he has also entered, he is short the asset. So he will have to deliver the asset, which is a zero coupon bond, and receive 517.5. As soon as he has short F1 here, is there any risk because of the asset price anymore? Now it doesn't matter whether the asset price increases or the asset price falls. I will receive 517.5 and I will have to pay $507. So what is my net payoff? It is F1 minus F0. It will be 517.5 minus 507. So 517.5 minus 507 is my assured payoff at the time t equal to 3. However, this payoff is coming to me when? At t equal to 2. At t equal to 2, when I short F1, I have assured myself this payoff. So at t equal to 2, the party who went long when the stock was 500 obviously had a view that the stock price will rise. That's why I went long. But at 515, his view could have changed. Now he doesn't feel that the stock will keep on going up. So he wants to lock in his profits. He can lock his profit by shorting a corresponding maturity contract. Corresponding maturity will be 1 month because the time to expiration of the first contract is 1 month. So this payoff that he has guaranteed himself, however, is at t equal to 3. So what is the present value of the payoff, or what is the value of the contract at t equal to 2? After 2 months, what is the value of the contract? This discounted back by 1 month. So this is called valuing off the market contracts. This is called valuing off market contracts. Calculate the no arbitrage price for a 100-day forward on a stock that is currently priced at $30 and is expected to pay a dividend of $0.40 in 15 days, $0.40 in 85 days, and $0.5 in 175 days. The annual risk-free rate is 5% and the yield curve is flat. Yield curve is flat means you could use the 5% rate for discounting all cash flows. Now, this stock is paying cash flows of 0.4 in 15 days and 0.4 in 85 days. So the formula remains the same, S0 into 1 plus R raised to power T. However, S0 will be replaced by S0 minus the present value of the dividends. So dividend of 0.4 is coming in 15 days, another 0.4 in 85 days, and 0.5 in 175 days. Does the third dividend payment matter to me? The third dividend payment is coming after the expiration of the forward. So this cash flow is not going to be received by either party. So this cash flow is not required for the calculation of no arbitrage price. So understand? Compute the present value of the dividend payments first. So the first dividend payment is discounted back by 15 by 365. The second payment is discounted back by 85 by 365. And the forward price is calculated as S0 E raised to into 1 plus R raised to power T. The T is 100 days forward, 100 by 365. Now in the same question we can value the off-market contract. After 60 days, the value of the stock in the previous example is $36. Calculate the value of the equity forward contract on the stock to the long position, assuming the risk-free rate is still 5% and the yield curve is flat. Now what has happened is 60 days have passed. This was a 100-day forward. I am at the time t equal to 60. First dividend payment happened at t equal to 15. Second payment was supposed to happen at t equals to 85. So the first has already been received. The second dividend payment of 0.4 is still pending. And now the stock has moved up to 36. We entered the forward at a price of 29.6. Remember, derivatives are zero-sum games, so whatever is the value to the long party, equal and opposite will be the value to the short party. So let's assume we are the long party. So we have entered in the forward at a price F0 of 29.6. At t equal to 60, if I have to exit this position, I can do it by shorting a 40-day contract, by shorting F1. So F1 will be equal to 36, that is the current price, minus 0.4, which is only 25 days away now. 5% is the rate of interest, raised to the power 25 by 365, whole multiplied by e raised to power RT, or whole multiplied by 1 plus 0.05 raised to the power. What is the time to maturity of the contract now? 40 days. So he will receive F1 because he is shorting the contract at F1. He will have to pay F0 because the contract is too long at F0. So pay F0 and receive the asset. He will give away the asset at a price of F1. So F1 minus F0 will be the payoff, which will happen at a time 40 days from now. So that's the value of the off-market contract with dividend payments. So let's see again. The dividend payment is at t equal to, so this dividend will still be under account. The first forward was written at 29.6. The current stock is 36. So the value of the new forward can be determined, which is 40 days later, and we can short that forward to exit our long position. Again, in this case, since the stock had moved up, the long position was in the money. Please verify all these calculations at your time. The value of the S&P 500 index is 1140. The continuously compounded risk-free rate is 4.6%, and the continuous dividend yield is 2.1%. Calculate the no arbitrage price. If the compounding is continuous, then you will replace S0 by S0 e raised to power minus R star t. So minus 0.021 into 140 by 365. So that's what you'll replace S0 by, and the formula remains S0 e raised to power RT, e raised to the power 0.046 into 140 by 365. So you need to subtract the continuously compounded dividend yield. It's similar to taking the present value of the dividend. Again, we can value an off-market contract. After 95 days, the value of the index in this case fell to 1025. Calculate the value to the long position of the forward contract on the index, assuming the continuously compounded risk-free rate is 4.6% and the continuous dividend yield is 2.1%. Now in this case, the long party must have lost because the actual value has, or the stock has fallen down. So again, we'll value it in the same way. The original price that we entered into was F0. We will compute the new price F1, and we'll assume that he's shorted it at F1. So F1 minus F0 upon 1 plus R raised to the power remaining time to maturity is how you solve the question. So the value comes out to be negative because the stock has moved down, so the long party will lose. The value to the short party would be an equal positive amount, so it would be plus 112.14. Calculate the price of a 250-day forward contract on a 7% US Treasury bond with a spot price of $1050, including accrued interest. So this is the dirty price. This is the price that I will actually have to pay. So it's the price that I need. So no new information here. That has just paid a coupon and will make another coupon payment in 182 days. The annual risk-free rate is 6%. So what is the spot price? It is 1050. It's a 7% US Treasury bond. Since it's a US Treasury bond, it makes semi-annual coupons. So coupon payment would be of $35, which is happening when? At the end of 182 days. Treat the coupon payments like cash flows or like dividend payments. So the spot price for the purpose of the forward calculation would be S0 minus the present value of the dividend. Now we want to value a 250-day contract. So raise this by 1.06 raised to the power 250 by 365. So I'm assuming annual compounding for the rate. You could assume semi-annual compounding also in the questions of bonds. So compute the present value of the dividend payment. 35 upon this. Remove the present value from the spot price and compute the fair forward price. Again, you could be asked to value an off-the-market forward. The value of an off-the-market forward is computed by computing the new forward price, taking an offsetting position in that new forward, and computing the cash flow. Discount the cash flows back to the present value. That is incidentally the value of any asset. It is the present value or the discounted back value of the cash flows. So the first thing that you do is estimate your cash flows and then discount them back to get to your present value. Now, LIBOR is calculated as an add-on rate. So let's recall from level 1. LIBOR is the rate that banks have to pay for deposits of a particular maturity. So let's say the 30-day LIBOR is 6%. What it means is that if you're making a 30-day deposit with a European bank, the deposit is denominated in dollars, then you will receive whatever is the amount you invested, let's say $100, into 1 plus 0.06 into 30 by 360. So remember, the convention in the LIBOR market is 30 by 360. That is, a month is 30 days and a year is 360 days. So 1 plus 0.06 into 30 by 360 is the amount that you will get back. So you will not raise to the power 30 by 360. You will not apply the concept of compounding here. You will be computing the LIBOR payment as add-on rate. So LIBOR is an add-on rate. So if you had a 6% rate of interest on a $1 million deposit, you would receive an interest amount of $1 million into 0.06 into 30 by 360. And the borrower would repay $1 million plus 5,000, that is $1,005,000 at the end of 30 days. Just like you had forwards on stocks, bonds, you can have forwards on interest rates as well. So interest rate forwards are called forward rate agreement. So if you recall, a forward rate agreement is an agreement to lend money and for the other counterparty to borrow money at a pre-decided rate at a pre-decided time. So if you've agreed on a 1 into 4 FRA, that means, so 1 into 4 convention, please understand the convention, that means 1 month later I will borrow for a period of 4 minus 1, 3 months at a pre-decided rate. So 1 into 4 means 1 month later borrow for a period of 4 minus 1, 3 months. What would be a 6 into 9 FRA? 6 months later borrow for a period of 3 months. Now this borrowing has to happen. It is a forward rate agreement. So the lender has to lend and the borrower has to borrow. So let's say the 6 into FRA rate agreed upon is 5%. Actual rates are 6%. Who gains? The borrower or the lender? So the long party, remember, the long party of an FRA is the borrower. Why? Because he is borrowing at 5%. The market rate of borrowing is 6%. So he has interest savings of 1% for a period of 3 months. Now calculate the price of a 1/4 FRA, that is a 90-day loan 30 days from now. The current 30-day LIBOR is 4% and the 120-day LIBOR is 5%. So currently, if you were to borrow for 4 months, you would have to pay, for 1 month if you were to borrow, you would have had to pay 4%, and if you borrowed for 120 days, you would have had to pay a rate of 5%. So if I borrow $100 for a period of 120 days, how much would I have to pay? So that's the convention in the LIBOR market. I would pay 100 into 1 plus 0.05 into 120 by 360. Instead of borrowing for 120 days directly, can I choose to borrow for 30 days? So I know I need a loan for 120 days, but let's just borrow for 30 days to begin with. We'll see what to do after 30 days. So what is the rate that I will receive for a 30-day borrowing? It will be 4%. So this is the amount that I'll have to repay after 30 days. But do I have the money to repay after 30 days? No, because I need it for 120 days. Instead of that, for some reason I just chose to borrow for 30 days. 30 days later I'll have to return the bank this entire amount of money. That means I'll have to borrow this entire amount from another bank for a period of how many days? 30 days have already passed by, so I need the borrowing now for another 90 days. So what will I get? I will get the 90-day rate one month from now. And this is the total amount of money that I'll have to pay back. Now in both cases, in case 1 as well as case 2, what I have achieved is a 120-day borrowing. Here I borrowed for 120 days directly. Here I borrowed for 120 days by borrowing for 30 days first and then refinancing for another 90 days. The cost of borrowing through both methods must be the same, otherwise there will be an arbitrage opportunity. So the cost of borrowing must be the same, otherwise there will be an arbitrage opportunity. That is, if this comes out to be cheaper, then nobody will ever borrow in this fashion. If this comes out to be cheaper, then nobody will ever take the first route. So they must be the same to avoid any arbitrage opportunity. Using this equation, can I compute the value of R1 into 4? So the value of R1 into 4 can be computed. It will come out to be 1.33 multiplied by 4, 5.32%. So if you solve that equation, it will be 5.32%. So 1 by 4 just represents 4 minus 1, 90-day rate. So 4 minus 1 is 3. And 1 represents that it's the rate 1 month later. So the 90-day rate 1 month later, because this is the rate that I'm freezing 1 month later. Which will come out to be 5.32%. Continuing the prior example for a 1:4 FRA, assume a notional principal of $1 million and that at contract expiration the 90-day rate has increased to 6%, which is above the contract rate. Calculate the value of the FRA at maturity. So when will be the expiration of this FRA? It will be 30 days from now. So 30 days from now, I have entered into a contract at 5.32%. The actual rates are 6%. So I have an interest saving of how much? 6% minus 5.32%. However, it's a borrowing for only 90 days. So the interest saving will be only for 90 days. On a notional of $1 million. This is the saving that will actually accrue when? At t equal to 30 or at t equal to 120? You need to pay the interest at the end of the period. So the savings will accrue at t equal to 120. The value of the FRA has to be calculated at t equal to 30. So I will discount back these cash flows at the current rate of interest, which is 6%. I want to calculate the value at t equal to 30. So I have to discount it back 90 days. So this is the interest savings. However, the interest savings have to be discounted back by 90 days. Value of 5.32% 1:4 FRA with a principal amount of $1 million 10 days after the initiation. If the 10-day LIBOR is 5.9% and 20-day LIBOR is 5.7%. So let's understand this. Now I entered into the contract here at t equal to 0. So at t equal to 0 I entered the contract. The contract was supposed to mature at t equal to 30 for a 90-day loan, and based on the interest rates here, I decided that the fair price should be 5.32. Now what has happened is that 10 days have passed. What does this FRA look like now? What is the time to expiration? It is 20 days. And what is the period of the loan? It is 90 days. So the 30 into 120 day FRA that I entered into 10 days later will just look like a 20 into 110 day FRA. That is, it expires or it matures 20 days from now and is for a loan which has a duration of 90 days. So compute the 20 into 110 day rate with the given information. If I just go out and borrow for a period of 110 days, then the rate that I'm getting is 5.9%. Instead of that, I can borrow for a period of 20 days. The 20-day LIBOR is 5.7. and refinance for a period of 90 days. So will I get the 90-day rate? The 20 into 10 or the 90-day rate now multiplied by 1 plus x into 90 by 360. So x is the rate of the new FRA that I can enter now 10 days later. Please note 20 into 110 will also be a 90-day loan. So let's compute x, let's compute the value of the new forward rate in case I chose to enter a similar contract now. A similar contract would be 20 into 110, not 30 into 120 because 10 days have passed. So the new FRA comes out to be 5.925%. So the new rate, that is the 90-day rate now, comes out to be 5.925%. That means if somebody wants to lock in his borrowing rate now for a period of 90 days starting 20 days from now, he would get a rate of 5.925%. What is the rate that I have locked in? I have locked in a rate of 5.32% for a similar borrowing. So has the long party gained or lost? Current contracts are getting locked in at 5.925%. I have already locked in a rate of 5.32%. Again, I can capture my gains or I can exit my position by shorting this FRA. So this FRA I was long. I was borrowing at this rate and I will lend it at this rate. So now you short the 20 into 110. That means you lend at 5.925%. You are borrowing this money at 5.32%. So what is the savings that you have realized? It will be 5.92 minus 5.32. But when are these savings accruing to you? At t equal to 10 or at t equal to 30 or at t equal to 120? You have locked in these savings, but these savings will accrue to you at t equal to 120. This is the loan. The loan will start, but the interest will be paid at this point at t equal to 120. So this is the savings that will accrue to you at t equal to 120. So what is the value of the FRA today or at t equal to 10? You will have to discount it back 110 days. So the value will be 5.92% minus 5.32% into 1 million, which is the notional, into 90 by 360. Please don't forget to multiply by 90 by 360. It's not a 1-year loan. It's only a 90-day loan. So your savings will also be corresponding to 90 days. Upon 1 plus, I have to discount it back 110 days. So I will use the current 110-day LIBOR to compute the value of the FRA today, that is at t equal to 10. So the value of the FRA is positive because the interest rates have gone up. So 5.925% into 90 by 360 into 1 million is the interest savings. The interest savings are coming to me 110 days later. So I will discount them back by the 110-day LIBOR. Finally, let's understand currency forwards once again. Just like we have forwards on interest rates or stocks or bonds, we can have forwards on interest rates. The risk-free rates are 6% in the United States and 8% in Mexico. The current spot exchange rate is $0.085 per Mexican peso. Calculate the forward exchange rate for a 180-day contract. Now you can remember this formula, I will prove it, however no harm remembering that the forward rate upon the spot rate is equal to 1 plus the domestic risk-free rate upon 1 plus the foreign risk-free rate raised to the power t. The only precondition is that the forward rate and the spot rate should be in direct quotes. So all rates should be in direct quote. What is a direct quote? How many units of domestic currency for 1 unit of foreign. So INR 45 per dollar is a direct quote for Indians. $0.02 per INR is the same exchange rate, but will be the direct quote for a US citizen. So how much of the domestic currency do I need to pay for 1 unit of the foreign currency is called a direct quote. Study that better in the review on economics. However, understand, for the CFA exam, always take domestic as USA. Okay, so become the citizen of US, become the investor of US before you start solving questions on currencies, and bring everything in your direct quote. So in this case, the exchange rate is $0.085 per Mexican peso. So is it a direct quote for a US investor? Yes. So we can apply this formula and understand and get to the forward rate. However, let's understand how do we get or how do we prove this forward rate. What are the risk-free rates in the US? It is 6%. In Mexico it is 8%. If currencies do not move, currency rates remain where they are, it will be a good profitable strategy to borrow in the United States and to invest the money in Mexico. So borrow at 6% in the United States and invest the money at 8% in Mexico. The current exchange rate is $0.085 per Mexican peso. Now if I borrow $1 in the United States, how many Mexican peso will I be able to convert it into? So borrow $1 because it's cheaper and convert it into Mexican peso. So it's $0.08545 is what you have to pay for 1 Mexican peso. So for $1, how many Mexican peso will you get? 1 upon 0.0845. This money you should invest at the rate of 8% for a period of 6 months. It's a 180-day contract. So for a period of 6 months, invest this Mexican peso. Six months later, you repatriate the money. Now let's say the forward rate has become F, or let's say the forward rate that you initially agreed upon was F, because you always knew you were going to repatriate this money back to the US. So you borrowed $1 and you agreed upon the rate F to repatriate the peso. So this is the amount of dollars that you will get back. $1, converted into Mexican peso, invested it in Mexico and returned it. So I divided it. So it's F dollars per Mexican peso. This is the amount of Mexican peso that I have. So I'll multiply it by F to compute the amount of dollars that I will get back. How many dollars do I need to pay as interest? Or how much do I have to pay to the US authorities? I borrowed $1. So 1 into 1.06 raised to the power 1 by 2 is what I need to pay as interest. If I am able to make any positive dollars out of this, that means there's an arbitrage opportunity. So for no arbitrage opportunity, profit from this strategy should be equal to 0. If I take 1.06 raised to the power 1 by 2 the other side, this will simply become f into, or 1 into 1.06 raised to the power 1 by 2. If I rejuggle, I will get to the exact same formula, that is f will be equal to 0.0845, that is S, current spot rate, into 1.06 raised to the power 1 by 2 divided by 1.08 raised to the power 1 by 2. So you will not have the time to derive it every time in the exam, so just remember that the forward rate would be the same as the spot rate multiplied by 1 plus RD, domestic is US in this case, raised to the power T, upon RF, 1 plus RF raised to the power T. All quotes have to be direct quotes, however, understand, otherwise you'll get it wrong. So become a US investor, get everything in your direct quote. Direct quote means how many dollars do you have to pay for 1 unit of the foreign currency. So it will be 0.0845 into 1.06 raised to the power 180 by 365 upon 1.08 raised to the power 180 by 365. Calculate the value of the forward contract in the previous example if after 15 days the spot rate is $0.098 per Mexican peso. So I entered into a 180-day contract. The contract that I entered into was for an exchange rate of 0.0837. So I locked in an exchange rate of 0.0837. Now after 15 days, the spot rate has become 0.0980. So let's compute the new forward rate. It will be the spot rate into 1.06 raised to the power, now 15 days have passed, so it will just be 167 days remaining upon 365. Assuming the interest rates haven't changed, the question doesn't mention that, but if the new rates have also changed, then please use the new rates into 167 upon 365. So you'll be able to compute the new forward rate. You can exit the contract by, so you are long at this price by shorting it at the other price, by shorting it at 0.09718. So for $1 or for point, so the agreement that you have is that for $1, rather for a Mexican peso, you will get $0.0837. However, you can short the Mexican peso at $0.09718 because that is the new rate. So have you gained money or have you lost money? So you will buy 1 peso. So you will buy 1 peso and pay how much? And pay $0.0837. But you will sell this peso. So you will sell it for how much? 0.09718 because that is the new rate. So how much have you gained? 0.0978 minus 0.0837. So you've gained 0.09718 per peso minus 0.0837. However, again, this is a gain that is coming to you when? It is coming to you 167 days later. So you will have to discount it back by 167 days at the US rate of interest. So 1.06 raised to the power 167 by 365. it was a 180-day contract, so it will be 165 days, not 167. My apologies. So you solve it in the manner that we did, and you'll get to a dollar value of $0.0131. Again, you computed, you were long the peso at this rate. Now the forward rate has changed to 0.09718. You short it at this rate. So you will buy a peso and pay minus 0.070837, and you'll sell it for $0.09718. So it's $1 per peso. So net you're left with the difference. However, this is the positive value that you'll realize 167 days later. So discounted, this is dollar value, so discounted by the dollar rate, which is 6%. You'll get to the same answer as $0.0131. Now futures are contracts that economically speaking are the same as forwards. However, they are regularized to the extent that they are done on an exchange. So a forward contract is essentially a contract between any two counterparties, A and B. Okay, these are called over-the-counter contracts. When done through an exchange, the same contracts are standardized. That is, the exchange makes sure that the quality of the delivered asset is in line with what the participants agreed upon. The exchange makes sure that the long party actually pays the short party. The exchange eliminates credit risk by taking some upfront money by both the long and the short position, such that if one party goes into a loss, he doesn't have to, or he doesn't have the option to run away and renege on the contract. So let's say I enter into a forward contract to buy an asset for a price of $100 100 days later. So I long a contract. What is the upfront payment that I need to make? Or let's say I enter into a contract to sell an asset for $100 100 days later. What is the upfront payment in either of these contracts? Right now, at t equal to 0, how much will I have to pay if this is a forward contract? It will be 0. As the asset prices change, as the stock price moves up or down, we understood from the previous examples that there could be a gain or a loss. Now, if there is no upfront money that I've taken, the party who is in a loss can simply choose to default or run away and not pay the winner any money. To avoid this possibility, the exchange in futures contracts, okay, not forward, in futures contracts would require both counterparties to pay some margin money. So both the long party and the short party will have to pay some 20%, 25% of the contract value as margin money. Now the party who is in a loss will have to subsequently keep paying up more and more margin, such that there is very little risk that the counterparty can run away in the case of a default. Now the question asks is, would you prefer to be in a forward contract or in a futures contract? Would you prefer to be in forwards or futures? It depends. Okay? It depends on the correlation of the asset with interest rates. If the correlation is positive, it means when asset goes up, rates also go up. If correlation is negative, means when asset goes up, rates go down, and vice versa. Now let's see why this makes a difference. This makes a difference because of the margining requirement that I just talked about. Now an asset goes up, who gains? The long will gain. As the long gains, he is allowed to withdraw his margin money. So the margin money that he had put is now no longer required to that extent because he's already gained a lot, so he can withdraw some of the margin money. So he can withdraw the margin and invest at a higher rate. Because the rates have also gone up. We're talking about case 1, where there's a positive correlation. And what about the short party? Short will lose, he will have to put up more margin and he will borrow the margin or borrow the money at a higher rate. So the short is at a slight disadvantage. So if there is a positive correlation, then short is at a slight disadvantage. So the futures rate will be slightly higher because the short as compared to the forward, okay? It's only as compared to the forward. Because the short party has two options. He can either be in the forward or in the future. If he is in the forward, he is better off because there is no margining required, there is no mark to market happening. Whereas if he is in the futures, then he has this negative impact in case interest rates fluctuate. When he is in the money, that is when the stock goes down, anyways the interest rates also fall. So he can withdraw and invest it only at a lower rate. So short will say that I will rather be in the forward, unless in the future I get a higher price for selling. Unless I get a slightly higher price for shorting. Similarly, if the correlation is negative, then it is favorable for the short position. If the correlation is negative, he will be in the futures even for a slightly lower price. So the short essentially delivers the asset and receives the money. Even if he is getting slightly lesser, he is okay because he has this positive margining impact when rates and asset prices fluctuate. If the correlation is 0, then there will be no preference. The forward and the future price will be the same. So here the future will be slightly lower, here the future will be slightly higher than the forward price. Assume the spot price of gold is $900 per ounce and that the 1 year futures price is $975 per ounce and that the investor can borrow or lend funds at 7%. Ignore transaction and storage costs. Calculate the arbitrage profit. Because he chose to take gold, he could have taken any asset to explain the concept of cash and carry arbitrage. So from what we have studied till now, compute the fair forward price or the fair futures price. What should F be? As far as calculations are concerned, all calculations remain exactly the same in forwards and futures. So what is the forward price going to be? It will be 900 into 1 plus 0.07 raised to the power 1. So it will be 911.22 That is the fair price or the fair forward price or the fair futures price. However, what is the observed price? The observed market price is 975. The observed market price is 975. It's something like you compute the fair stock price of a stock as 50 and the observed stock price is 70. So what will you do with the stock? So if a stock has a fair price of 50 and market price of 70, what will you do? Short the stock, sell it. Now the fair forward price is 963. The observed forward price is 975, or the futures price. So what will you do? You will short the future. So remember, in arbitrage, identify any one market as cheap or expensive. So if you've identified any one market as cheap, just long it. If you've identified any market as expensive, just short it. In this case, we have identified the futures market as expensive because the futures price is 975 and the fair futures price should be 963. So simply short the future. Now, an arbitrage is a transaction, or in an arbitrage transaction, the arbitrager brings in no money. So he brings no money from his pocket. So whatever has to be done to exploit the market anomaly by using borrowing or lending or by using the market instruments. So in this case, he is short the future. If he's short the future, means he'll have to deliver the asset. How will he deliver the asset? He will have to long it. So he will long the asset in the spot, short it in the future, long it in the spot. But for longing the asset in the spot, he needs how much money? $900? Does he have $900? Even if he has, he doesn't bring it in. For arbitrage transaction, you make risk-free money. That is, you don't bring any money from your pocket and you still make a profit. So he will borrow $900. So that's the transaction that he'll do. Short the future, borrow 900 from a bank and long the spot. Compute the arbitrage profit if he borrows just $900. If he borrows just $900, that means at maturity he will have to sell the asset which he bought by borrowing for what price? For $975, and he'll have to return how much? He'll have to return $963 to the bank because he borrowed $900. At the end of 1 year, he'll have to return $963. So for every $900 of borrowing, he makes a profit of $12. For every $900 of borrowing, he makes a profit of $12. Had he borrowed $1,800, he would have made $24. So the more he borrows, the more arbitrage profit can be made. Theoretically, he can make infinite amount of money. If the market remains like this, he can borrow infinite amount of dollars and make infinite money. Obviously, when he starts buying more, the price of the spot will either go up or the price of the futures will come down, such that the arbitrage opportunity does not persist for very long. Now that's called the cash and carry arbitrage. What we're going to study now is called the reverse cash and carry arbitrage. In the same question, assume the futures observed market price was not $975, rather it was just $945. It wasn't $975, it was only $945. And that an investor can borrow and lend funds at 7%. Ignore transaction and storage costs. Calculate the profits from arbitrage. The fair forward price is 963 as we calculated. Now we have identified the futures as cheap. So you should long the future because the future is cheap. Now again, if you have to long the future, you will need to have $945. How will you get the $945? By shorting the stock today. So short the stock in the spot. It will give you $900 because the current price is $900, and invest that money in a bank. So you long the future and short the stock in spot. You will receive $900 invested in the bank. So how much money will you have at maturity? You will have $963 from the interest that you received, of which you will have to pay $945 to buy the stock and give it back from who you borrowed it. Why did you borrow? You borrowed it to short. In level 1 we studied short sale transactions, that is you borrow the stock and you sell it and then you return the stock back. So you'll have an arbitrage profit of $18. This is called the reverse cash and carry arbitrage. The earlier transaction was called cash and carry. This is called the reverse cash and carry transaction, wherein you long the future. So backwardation is a situation where the futures price is below the spot price. Contango is a situation where the futures price is above the spot price. And the futures price can be below the spot price if the dividend yield is very high or the convenience yield is very high. Convenience yield means the benefit from holding the asset or the commodity is very high, such that subtraction of the present value of dividend, or the e raised to power minus r star t, makes the futures price actually lower than the current spot price. Calculate the no arbitrage futures price for a 1.2 year futures contract calling for the delivery of a specific bond, that is a 7% Treasury bond with exactly 10 years to maturity and a price of $1040 when the annual risk-free rate is 5%. So now we talk about futures in specific markets, that is the bond markets, currency markets, stock markets. So compute the no arbitrage futures price. So exactly 10%, 7% coupon and 10 years to maturity and a current price of 1040. So again the valuation concept remains the same. First we remove the coupon payments. There will be 2 coupon payments in the 1.2 year period. The period is 1.2 years. The first coupon payment will happen 6 months later, which will discount it back by a period of 6 months. The second coupon payment will have 1 year later, which we will discount by a period of 1 year. The present value of the coupon payments has to be raised to the power of 1.2 into the interest rate, into the rate of interest. So the first coupon is coming one year later, and the second coupon is coming at 6 months from now. So it will be 1040. Never mind the explanation above. Both will give you the same answer, guys. Both this method and the method I am explaining. Present value of the first coupon minus the present value of the second coupon raised to the power 1.05, which is the rate of interest, to 1.2, because there is 1.2 years to maturity. So from the current spot price, remove the present value of the dividend payments and apply the formula F is equal to S naught e raised to power RD. Now let's understand a little bit about how the Treasury bond futures market works in the real world. Now let's see counterparty A and B enter into a futures. So A is long and B is short. A 10-year bond with 5% coupon and $100 par. The expiration of the contract is 3 months later. So the contract is as follows, that 3 months later, at a price of $102. So the contract is that 3 months later, A will buy this exact bond, the bond as described above, and pay a price of $102. It is a right as well as the obligation. So A has to buy and B has to deliver. Now let's say 3 months has passed and the time to delivery comes. So A has $102. Now B has to go in the market and source a bond which has exactly 10 years remaining to maturity, pays exactly a 5% coupon and has a par value of $100. So par value is not a problem, but he'll have to find a bond which has exactly 10 years to maturity and 5% coupon. Now do you think the government of any country issues bonds keeping in mind that somebody must be entering into a forward contract or a futures contract today? Or the government issues bonds based on when it requires money, when it needs the money. So bonds are issued from time to time. They may have a 4.9% coupon, some may have a 6% coupon, some may. Now at any point in time, there will be many bonds outstanding in the market. Some will have 4 years, 11 months to delivery. Some will have 5 years to delivery. Some will have 8 years to delivery. Some will have 10 years, 2 months to delivery. So to maturity I meant. So the time to maturity for many bonds outstanding, there will be thousands of bonds outstanding, but they will all have different times to maturity. Finding bonds with exactly 10 years to maturity and 5% coupon would be difficult for the short. To get away with this problem, or to curtail this problem, what the exchange does is that it defines a set of bonds that are deliverable. So if the agreement was to deliver a 10-year 5% coupon bond, then the short is allowed to deliver any bond with 8 to 12 years of maturity and 4 to 6% coupon. Even though they agreed upon the price of a 10-year 5% coupon bond, the short will be allowed to deliver any bond with the given range of maturity and coupon. Now, if he delivers a 6% coupon bond, so in the market 5% coupon bond was not available, so he went and he bought a same 10-year maturity but a 6% coupon and delivered it to A. Should this short get, or should he get $102 or slightly more or slightly less? A and B agreed that the price of a 10-year 5% bond should be 102. Now I went and actually delivered him something that is giving him 6% coupon. So A also realizes that I'm getting more coupon, so A will be willing to pay a slightly higher price. Similarly, if he went and delivered a 4% bond, or a bond which had a lower time to maturity or slightly different, it can be calculated whether A would be having to pay a slightly higher price or a slightly lower price. That slightly higher or slightly lower is defined by something called as conversion factor. So conversion factor is not in the hands of A or in the hands of B. Conversion factor is notified by the exchange, and the exchange says that okay, all participants will debate on the price of a particular bond, which is a 10-year 5% bond for instance. However, depending on which bond is being delivered, the price to be paid is equal to the agreed upon price, which is 102 in this case, multiplied by the conversion factor. If you were delivering the exact same price, you would have to just pay F, the long party. But because you are delivering something which is slightly different, the long party will have to pay F into the conversion factor. Conversion factor can be greater than 1 or less than 1. This will be notified by the exchange. It is to do away with the problem that exact requirements of the bonds may not be met at any particular time. Suppose the futures contract from the previous examples allows delivery of many different bonds. The conversion factor for the 10-year 7% Treasury bond is 1.13. Calculate the appropriate no arbitrage futures price. So for this bond, the price came out to be, the fair futures price came out to be 1031.15. Now, this is not the exact bond. The 10-year 7% bond that we delivered was actually one of the other bonds, and hence it has a conversion factor of 1.13. So the fair forward price into 1.13 has come out to be equal to 1031. Why? Because the bond that was agreed upon was a slightly different bond. He is delivering the 10-year 7% bond, and hence he will have to receive a price of F multiplied by the conversion factor about the short position, and the long will have to pay so much. So what would be the no arbitrage futures price for the original bond on which they would have debated? It would have been 1031 upon the conversion factor. So if the conversion factor was 1, then there would be no change. The calculated no arbitrage future price would be the same as the futures price. Now at level 1 we studied the put call parity, which essentially said that the price of a call option minus the price of a put option is equal to the spot price minus the strike price upon 1 plus r raised to the power t, where t is the time to maturity of the option. We could use this relationship to create synthetic options. That is, rather than buying a put option directly, I could buy a put option as a combination of a call option, stock price, and the risk-free rate. So in this case, compute the price of a put option given the other prices. So I'll take P that side. So price of put option becomes equal to the price of a call option minus the stock price plus K upon 1 plus R raised to the power T. Please substitute all the values as given in the question. Spot price is given to be $62. The price of a call option is given to be $8. The strike price or the exercise price is given to be $60. Remember, the call option is an option to buy the asset at a pre-decided price. It is an option. That is, it is a right but not the obligation. A put option is a right. That is, if I want to, I can sell the asset at a pre-decided price at a pre-decided time. However, it is not an obligation. So if I don't want to sell it to the counterparty, I can sell it in the market as well. So depending on where I get a better price will decide whether I exercise the option or not. So price of a put option comes out to be $3.69. The stock of Arb City is trading for $75. A 3-month call option with an exercise price of $75 is selling for $4.5, and a 3-month put at the same strike price is selling for $3.8. The risk-free rate is 5%. Calculate the no arbitrage price of the put option. Again, let's apply the same formula. The no arbitrage price of a put option would come out to be the price of a call minus the stock price plus K upon 1 plus R raised to the power T. So what is the price of a call option equal to? 4.5 minus what is the spot price equal to? 75. What is the strike price equal to? It is the same as 75 upon 1 plus R, the rate of interest is 5%, raised to the power T. The time to maturity is 3. So the no arbitrage price of the put option comes out to be equal to 3.59. This comes out to be 3.59. The observed market price of the put option is 3.08. Again, the principle of arbitrage. Short what is expensive. Is the put option cheap in the market or expensive? You should be getting it for 3.59. You're actually getting it for 3.8. So short in the market and long synthetic. Short in the market and long synthetic. So you'll shorten the market and you will receive $3.8 as premium. You will long in the synthetic market and you'll have to pay only 3.59. So you'll make an arbitrage profit per put option of $0.21. Let's recall how do we create a synthetic put. Again, remember, long put means minus P. Long put option means I'll have to pay the premium. So you can create a long put by what is minus C? Long call. What is plus C? Short stock. Because if I short stock, I'll have an inflow of S, and minus KE raised to power minus RT means invest at the risk-free rate. It's again a negative. It implies lending. It implies investment at risk-free rate, or you can say lending. Create a synthetic short stock position, please. Short stock will be represented as plus S. So plus S can be written as C minus P plus KE raised to power minus RT. So a short stock position can be created by short call. Short call means plus C, I will receive the premium. Long put, that is a minus P, I will have to pay the premium. And plus KE raised to power minus means borrowing at risk-free rate. If I borrow at the risk-free rate, it will be represented as positive in my portfolio. So this is how we can create synthetic option positions. In this case, short the market and long the synthetic. It doesn't matter where the stock ends up, you will make the arbitrage profit. You will make an arbitrage profit of $0.21 per put option, regardless of where the stock price ends. Now, how do we price options? Now, valuing options is a little complicated as we need to consider various scenarios. Options have non-linear payoffs, unlike futures and the other derivatives that we studied till now. That is, if in the money, the option payoff will be positive. If out of the money, the option payoff will simply be 0. There will never be an outflow over and above the premium for the buyer of the option, either a call or a put option. Now, what we're going to study is the method of option valuation by using binomial trees. So, assume that a share of stock is currently priced at $30. Please recall we studied binomial trees while valuing fixed income securities. The size of the possible changes and the probability of these changes occurring are given as follows. So, U is the size of an up move, D is the size of a down move, pi U is the probability of an up move, and pi D is 1 minus the probability of an up move, it's the probability of a down move. Compute the price of an option. Now, the current share price is 30. In the coming period, there are two possibilities. The stock can either go up or the stock can go down. Stock can go up to a value of 30 into U, or the stock can go down to a value of 30 into D. The probability of an up move is 55% and the probability of a down move is 45%. The size of an up move is 1.33 times. So stock can become either 40 bucks or it can become 30 divided by 1.33. Given these possibilities, compute the price of the option. The probabilities that were given as 55 and 45% can be actually calculating using this formula. That is, the probability of an up move can be calculated as 1 plus the risk-free rate minus the size of a down move, which is 1 over 1.33 upon 1.33 minus 1 upon 1.33. So these formulae are derived using the assumption of geometric Brownian motion. That is, if the stock price follow a random motion, you don't really need to understand how these formulae are derived, but just understand that under certain assumptions of random stock price behavior, we can conclude that the probability of an up move is given by this function and the probability of a down move is simply 1 minus probability of an up move. So these values will be given to you. You will not be asked to derive the size of a down move, size of an up move. Probabilities can be calculated given the risk-free rate, the size of a down move and the size of an up move. So this probability is 55% in the question and it's 45% for the down move. Now for this question, assuming the risk-free rate is 10%, compute the value of a call option with a strike of 30 rupees. Assume the risk-free rate is equal to 10%. Compute the price of a call option with a strike of $30. So strike price is $30. Possibility is that the stock can be 40. So 30 into 1.33 will be 40. So it is 30 right now. It can be 40 or it can be 30 upon 1.33. which will be something less than 30. So if the stock moves up to 40, what is the value of the option? The option will give you $10. That is 40 minus 30 because the strike price is 30. If the stock moves down, what is the value of the option? Remember, the value of the option can never be negative. It can go down to a maximum value of 0 or the worst price of 0. That is, the option will not be exercised. The buyer of the option will simply let it go. There is a 50% chance, 55% chance of this happening and a 45% of the latter happening. So what is the expected cash flows at time t equal to 1? It is 0.55 into 10 plus 0.45 into 0. So this is the expected cash flow from this call option. This cash flow is expected when? 1 year later. So what is the price that the buyer of the option will be willing to pay today? It will be the present value of these cash flows. So it will be 0.55 into 10 plus 0.45 into 0 upon 1.1. Let's do one more question and understand this. Suppose you have a stock currently priced at $50 and a 2-period European call option is available with a strike price of 45. European implies that the option cannot be exercised before maturity. The size of an up move is 1.25. The risk-free rate per period is 7%. Compute the value of the call option using a 2-period binomial model. So just like we extended our nodes till 1 period, now we'll extend the nodes till 2 periods. Let's see how the binomial tree will look. So the size of a down move would be 1 over the size of an up move, that is 1 over 1.25. This is given in the question. The size of an up move is given to be 1.25. The risk-free rate is given to be 7%. U is equal to 1.25. So can I compute the probability of an up move? The probability will be 1 plus the risk-free rate, which will be 1.07, minus the probability of a down move, which will be 0.8, upon the size of an up move, which is 1.25, minus the size of a down move. So probability of an up move comes out to be 60%. The probability of a down move comes out to be 40%. Starting with the original price of 50, let's construct the binomial tree. So there's a possibility that the stock will become 50 into D. So 50 into 1.25, that is $62.5. The probability of this is 60%. There's a 40% chance that the stock will become 50 into 0.8 or $40. Once at 62.5, there is again a 60% chance that the stock will become 62.5 into 1.25 or $78.13. There's a 40% chance that the stock will go down to $50 again, that is 62.5 or divided by 1.25. There's a 60% chance that the stock will go up to 50 from 40, and there's a 40% chance that it will go down to $32. Given these values, compute the value of the option today. It's a European option, that means it can only be exercised at maturity. If the stock exits at a price of 78.13, then what is the payoff from the option? The strike for the option is 45. So the stock price actually ends at 78.13. What will be the payoff? 78.13 minus 45. If the stock ends at 50, the payoff will be $5. And if the stock ends at 32, the payoff will simply be 0 because the option will not be exercised. Now, let's break this into 1, 2, 3, 4, 5, 6 nodes that the tree has. Standing at node 2, what do I see? At node 2, I will see there is a 60% chance of a payoff of $33.13, and there's a 40% chance of a payoff of $5 at node 2. However, either of these payoffs is only likely to happen 1 year later, assuming that the call option is for 2 years. Per period is 7%, yes, so it's a 2-year option. That's the value at node 2. Similarly, I can compute the value at node 3. At node 3, what do I see? A 60% chance of $5 and a 40% chance of $0. Either ways, the sum of the value looks to be coming 1 year later, so I'll discount it back by 1.07. I'll get the value at node 3 and node 2. The value at node 1 will be 60% into the value of node 2 plus 40% into the value at node 3 divided by 1.07, that is the value at node 1. So 33.13 or $5 or $0 is the three values that I see. So compute the value at node 2, compute the value at node 3, 60% chance of 5 and 40% chance of 0. Then there's a 60% chance of node 2 happening and a 40% chance of node 3 happening. So do it one more time and discount it back to node 1. That is the price that you will be willing to pay today. So 60% chance of node 2 happening, 40% chance of node 3 happening, as I will see from node 1. Discounted back 1 year, you will get to the call value of the call option today, or the price of the call option today. 60% chance of node 2 and 40% chance of node 3. Discounted back 1 year, you'll get to the price of the option today. So that's the binomial tree approach of valuing a call option. Similarly, we could use the binomial tree to price a treasury bond or to price bond options. So you want to value a European call option with 2 years to expiration and a strike price of $100. So now the option is on bonds. The underlying bond is a $100 par value, 70% annual coupon bond with 3 years to maturity. The figure below represents the first 2 years of the binomial tree for valuing the underlying bond. So this is the first 2 years. Fill in the missing data in the binomial tree and calculate the value of the European call option. So the option is a 2-year option. So the option expires after 2 years. However, this bond is a 3-year bond. The underlying bond is a 7% annual coupon with 3 years remaining to maturity. So the underlying bond is a 3-year bond. So let's see how the data looks like. So the following information is given. At the beginning of the year, the interest rates are 3%. At the end of 1 year, interest rates can either move up to 6% or they can fall down to 4.44%. At the end of the second year, interest rates can either be 8.56%, or they can be 6.34%, or they can be 4.7%. So tell me, at the end of the second year, if I'm standing here, what is the cash flow that I see? So 1 year has passed, actually 2 years have passed. This is year 1, this is year 2. 1 year is remaining. So what are the cash flows? Cash flows at maturity will be 107, regardless of where I am. So 2 years later, if interest rates have moved up to 8.56%, what will be the price of the bond? 107 upon 1.0856. Please verify, it comes out to be $98.56. At the end of year 3, if interest rates are 6.34%, then the value of the bond will be 107 upon 1.0634. If the interest rates have moved down to 4.7%, then the value of the bond will be 107 upon 1.047%. So here it comes out to be 100.62. The strike price of the option is $100. The strike price of the option is $100. So what will be the option value here? 0.62. Option value will be 0.62. Price of the bond will be 100.62. Similarly, in the third year, the bond price will be 102.196. So the value of the option will be 2.196, since it's a call option. Call option means I can buy the asset at 100 and sell it at 102.196. So the price of the option will be $2.196. Now let's assume there's a 50% probability of both up moves and down moves. Then what do I see at node 2? Again, let's call our nodes 1, 2, 3, 4, 5 and 6. So we've computed the value at nodes 4, 5 and 6. What do I see at node 2? I see a bond price or a bond value of 98.56 plus $7 of coupon, or I see a bond price of 100.62 plus $7 of coupon. So to derive the price at node 2, what do I see? Either I see 98. If the interest rates actually move up, then the price of the bond would fall to 98.56. However, I'm still getting the coupon of 7. Or I can get 100.62 plus a coupon of 7. Either ways, the value coming to me 1 year later, and the current interest rates are 5.99%. So I'll discount it back by 5.99%. So let's see how it look. There's a 50% chance that I see 98.56 plus the coupon, and there's a 50% chance that I see 100.62 plus the $7 of coupon. But the interest rates would be higher by 5.99%, so the price is 100.57. The 50% probability is to be given in the question. Okay, so the 50% probability is assumed in the question. Okay, you will not have to calculate this in the case of bonds. If the size of up move and down move is given, then you can calculate it. Otherwise, the probabilities will be given. Again, at the bottom node, there is a 50% chance of seeing 100.62. This is at node 3. And there's a 50% chance of seeing 102.2. So the price that I would be willing to pay is the expected value discounted back. What is the expected value? Add the coupon payments, multiply it by 0.5 and compute the numerator. The interest rates have moved down to 4.44%, so the present value will be 103.8. Similarly, we can compute the value of the option. It will be 0 into 0.5 plus 0.62 into 0.5 upon 1.0599, and it will be 0.62 into 0.5 plus 2.2 into 0.5 upon 1.044. I can discount back one more node to get to the price of the bond at initiation. That is, I see a value of 100.57 plus a $7 coupon with a chance of 50%, and I see 103.8. These two values come from the previous two calculations. The interest rate at the beginning is 3%, so the present price of the bond should be 106.0. Similar way, we could compute the value of the options. Discount the first at node 2, the value will be discounted back by 5.99%. So it will be 50% chance of no value, that is the bond moves down to 98.56. A 50% chance of seeing $0.62, that is if the bond moves up to 100.62. Either ways, it will be discounted back by 5.99%. So 98.56, 100.62 and 102.2 is what we calculated. The interest rates were given to us, and 50% probability of on the two arms is also given to us. So the option value looks out to be 2.22 here, 0.62 here, and $0 here. Discounted back, so the option value comes out to be $0.29, comes out to be $1.35. Discounted back by one more period, so the option value comes out to be $0.8. So the price of the option, or the value of the option, comes out to be $0.8, and the value of the bond comes out to be $106 at the beginning of the period. Just like we had call options on stocks, we can have call options on interest rates as well. So call options on interest rates are called caps, and they are actually a combination of multiple call options. So let's read the question. Suppose you purchase a 2-year cap with annual reset and a strike rate of 5% on a notional principal of $25 million. So it's a 2-year cap with a strike rate of 5%. So what it means is, it's a call option with a strike of 5% and annual reset. So every year we will see the interest rates. If the interest rates are actually higher than the strike rate, then the buyer of the call will exercise the option and receive a payment. If the interest rates are lower than the strike rate, then the buyer of the option will forfeit the option and just let it go unexercised. The notional is $25 million. Now, this is the other information given. Now, this option essentially consists of two call options. Why? Because it is a 2-year cap. So the first time we will check for the option exercise is 1 year later. So if 1 year later the 1 year rates are greater than 5%, then that will trigger a payment. And then the second testing I will do 2 years later. If 2 years later also the 1 year rate is greater than 5%, then that will trigger a payment. If the rates are lower than 5%, the option goes unexercised. So essentially there are two call options here. One at the end of 2 years and one option at the end of 1 year. So first let's value the option that comes at the end of 2 years. So these are the different possibilities given. Interest rates are 3% right now. They can become 6% or they can become 4.44%, 50% chance of everything happening. Interest rates can go up to 8.56% or they may come down to 6.34%. Similarly, interest rates may go up to 6.34% or they may come down to 4.7%. In the first case, or in any case, the payout from a cap, in case the rates end up at 8.56%. So this option can be exercised only 2 years later. Okay, we are not valuing the 1 year cap, we are valuing the 2 year cap left first. So will the option be exercised if the rates actually go up to 8.56%? So the payoff will be the notional, which is 25 million in this case, multiplied by how much in the money you are, that is 8.56% minus 5%, into the term of the caplet, which is an annual reset, so into 1 year. So compute the payoff, it will be 25 million into 3.56%. So it comes out to be 819,823. It comes out to be $890,000. Now, unlike FRAs or forward rate agreements, wherein this interest rate is 8.56% at this node, when will this interest saving accrue? Will it accrue at the end of 1 year, or will it accrue right here? So go back and see the explanation on forward rate agreements, or please recall from that explanation. This saving of $890,000 is going to actually accrue at the end of this period. So the interest rate at the end of 2 years is 8.56%. Here we checked for the 1 year rate. The savings, even if the cap is exercised here, the savings of $890,000 will accrue to me at the end of this period. So what will be the value of the cap here? So this savings comes at the end of this period. So you discount it back by 8.56%. So you discount this back to get to the value at the end of year 2. So it comes out to be $819,823. Similarly, if the interest rates are actually ending up at 6.349%, will the cap be exercised? Yes. The strike is lower, so the call option will be exercised if the spot is higher than the strike. I will borrow at the rate of 5 and lend at the rate of 6.34%. I will have a total profit or interest savings of 1.34% into 25 million. However, this saving will accrue at the end of 1 year. So the present value of this will be discounted back by 6.34%. In the final case, the strike will not be exercised, or rather the cap will not be exercised, since the strike price is 5% and the spot price is lower than the strike, so the call option will be unexercised. Now there's a 50% chance of a value of 819,823 and there's a 50% chance of 315027, as we see at node 1, or rather at node 2. Let's make it 1, 2, 3, 4, 5, 6. So at node 2 again, 50% chance of seeing this value, 50% chance of seeing 315025, multiply, compute the expected value, discount it back by 5.99%, you get the value at node 2. Standing at node 3, you see 50% chance of 0 and 50% chance of 315027. Multiply it, discount it back by 4.44%, you'll get the value at node 3. Again, 50% chance of node 2, 50% chance of node 3, discount it back by 3% to get to the value at t equal to 0. Let's see the calculation. One. So that was how we valued the 2-year cap. We'll give you the answer in a second. The option consists of 2 call options as we discussed. So the first one, or the first checking, will happen at the end of the 1 year. So how do you value the 1-year cap? The 1-year option will get exercised right at the end of year 1. So in this case the payoff will be 0.99 into 25. However, this payoff will happen at the end of the year. So the present value will be discounted back by 5.99%. And in this case, in case of node 3, what will be the value of the option? The strike price is 5%, so the value of the option will be 0. So the 1-year caplet has a value of 50% chance of the higher value and 50% chance of 0. So sum this up and discount it back by 3%. So these are the 2 options. Compute the value of the 1-year caplet and the value of a 2-year caplet. Sum it up to get the value of the cap. The cap is a 2-year annual reset. It means it has 2 call options. So for the 2-year cap, the value comes out to be, or the 2-year caplet, the value comes out to be 333094 in the manner that we discussed. For the 1-year caplet, the value comes out to be 113356. Sum the 2 to get the value of the 2-year cap, and we'll get the answer as $446,450. Please take your time and solve these questions. Any doubt, feel free to contact us. Just like we valued the cap, we can value a floor by valuing individual floorlets. A floor will be exercised if and only if the spot price is lower than the strike price. The payoff is calculated in a similar manner. However, exercise will happen only if it's like a put option. So floor is like a put option on interest rates. Only if the spot rates are lower than the strike rate will I exercise it. So floor is an option to lend. A call option is an option to borrow. Floor is an option to lend. So if I have an option to lend at 5% and actual rates are 6%, will I exercise? No, I won't, because I can lend in the market at 6%. So floor is like a put option and call is like a, or rather a cap is like a call option. So I wrote call here. A cap is an option to borrow. Now, this was the data presented. The question had 2 options. I would check for the interest rates twice, once at the end of year 1 and once at the end of year 2. Whenever the interests or the rates are greater than 5%, a payoff will be triggered. So how many options exist? For the buyer of a cap, how many options is he practically buying? 2, 1 at the end of year 1 and 1 at the end of year 2. So we will have to compute individually the value of each of the options and sum it up to compute the total value of the cap. So first we computed the value of the 2-year option, just like any binomial model that we have done in the past, that is assuming that the exercise will happen at the end of 2 years. Then we computed the value of the 1-year option, assuming that the exercise will happen at the end of 1 year. Then we added up the two values to compute the value of the cap, or the value of the two options that are embedded in the cap. Now, Black-Scholes did the exact same thing. So when Black-Scholes was asked to give an option pricing formula, he basically applied the binomial method only. However, he made the time periods between the two nodes as infinitesimally small. So what the Black-Scholes model does is, when we compute, this is how we compute the price of our call options, that it can be higher or lower. So Black-Scholes did the same thing. However, each of these time periods was infinitesimally small. So he created in his model infinite such nodes and tried to value European options. So Black-Scholes is only working for European options, so he'll keep going, it'll keep going, because each of these time periods is not 1 year, it's 1 millisecond. So there will be infinite such nodes used to value the option using Black-Scholes. Now the exact derivation is obviously not there in our curriculum. Black-Scholes got a Nobel Prize for this, so I'm sure we are not expected to know this. So we'll learn the Black-Scholes formula and learn its application. However, before that, we need to understand the assumptions that Black-Scholes made before understanding his option pricing formula. So the first assumption is that the price of the underlying asset follows a log normal distribution. Recall from level 1, a log normal distribution is a positively skewed distribution. The lowest value of a log normal distribution is 0. Assuming that asset prices follow a log normal distribution basically assumes that returns follow a normal distribution. So he assumed that asset prices follow a log normal distribution, or asset returns follow a normal distribution. The risk-free rate is constant and is known. This renders the model useless for fixed income securities. Because the assumption is that the risk-free rate is constant, we can't use it for pricing or valuing fixed income options or interest rate options, because the value of the option comes because interest rates fluctuate. So there we will have to use the binomial method. The volatility of the underlying asset is constant and known. Okay, so in practice it is difficult and volatilities keep changing, so that is a bit of a limitation. And it assumes that markets are frictionless. So what is the meaning of frictionless markets? Borrowing and lending infinite amounts can happen at the risk-free rate. There are no brokerages, transaction costs, restrictions on short selling, so on and so forth. So under the 4 assumptions that we just discussed, and please remember these assumptions are tested directly in the exam. That is, asset prices follow log normal, not asset returns. Asset prices follow log normal, asset returns you can say follow normal distribution. Risk-free rate is known as constant, volatility is known as constant, and markets are frictionless. There are no dividends. This is not a big limitation. The model can be adjusted like we studied by replacing S with the present value of S minus the present value of dividends in case dividends exist. But the assumption originally in the Black-Scholes model is that there are no dividends or no cash flows, and it works only for European options. So you can't value American options using this model. So this is the Black-Scholes model. It says the price of a call option is given by SND1 minus K or X e raised to power minus RT ND2. So N is the cumulative normal distribution. So N is a distribution like this. Okay, it is the cumulative normal distribution. D1 and D2 can vary from minus infinity to plus infinity. If D1 is minus infinity, then N of D1 will be 0. Or basically whatever is the input, or if D1 or D2 is plus infinity, then the value returned will be 1. So recall, a cumulative distribution, or the term cumulative means the number of values less than or equal to a given value. So in case of a normal distribution, the distribution can take on values between minus infinity to plus infinity. What is the probability that what is the number of values which are less than plus infinity? All 100% of the values are less than plus infinity. So this will vary from 0 to 1. What is the number of values less than the mean? If I give the input to this distribution as the mean, or 0, assuming a standard normal distribution, then what will be the cumulative number of values less than or equal to the mean in case of a normal distribution? Half the values lie to the left of the mean or less than mean, and half the values are greater than the mean. So if I give the mean or 0 as the input, then the cumulative normal function will throw a value of 0.5. So understand, ND1 and ND2 are values in between 0 and 1. And we'll study the significance of these values a little more. So D1 is further given by this formula. It is ln S0 upon X plus the risk-free rate plus 0.5 into sigma square whole multiplied by T upon sigma into root T. D2 is given by D1 minus sigma into root of T. T is the time to maturity as a percentage of a 365-day year. So 180 day means 0.5. 365 days means 1. S0 is the current stock price, X is the exercise price, RF is the continuously compounded risk-free rate, sigma is the volatility of stock returns, and we'll explain to you how volatilities need to be calculated. So volatility is calculated on a continuously compounded rate, and N is the cumulative normal probability of the value in parenthesis. So whatever is D1 or D2, whatever value you give it, it will give the cumulative normal probability. This value will vary between 0 and 1. So you need to remember, no need to remember D1 and D2. It will help, it doesn't harm to remember. However, you must remember the Black-Scholes formula. It is S0 N D1 minus X e raised to power minus RT into N D2. Once we know the price of the call option, since it's a European option, we can compute the value of a put option using the put call parity. So the value of a put option will be given by C0 minus S0 plus X e raised to power minus RT. So as the price of the underlying asset goes up, the value of an option will go up. It is easy to imagine because the call option will become more in the money. As the spot price goes up, the value of a call option at strike 50 will increase because call option gives you the right to buy at the strike price. So you are buying it at 50 and the stock is going up. So the option is becoming more valuable, it's becoming more in the money. That is what this graph represents. Similarly, as the price of the underlying goes up, the value of a put option will fall because the put option becomes out of the money. Put option is the right to sell or the option to sell at the strike. So the option to sell is at 50, let's say, and the stock is going up. Will you exercise this option? No. Why will you sell at 50? You will sell it at the market price. So as the stock goes up, the value of put option declines. This relationship is captured by a Greek or a value called delta that we'll study in the coming slides. As the volatility of the options increases, that is, as the volatility of the underlying stock price increases, the price of both call options as well as put options increases. So more the volatility in the stock, can you all imagine that more the probability of loss for the seller? The seller of the option can only have a loss. And the buyer can only have a profit once the premiums have been exchanged. So whatever is the upfront premium is the maximum profit that the seller can have. Please watch the video from level 1 on options to see the payoff curves on each of these instruments. Now, if the volatility increases of the underlying, then the probability is higher that the call option can come in the money, that is, the stock can really move up, or the put option can come in the money, that the stock can really move down. So the probability of a huge loss to the seller increases, and hence the seller will charge a higher premium. Higher volatility means higher premium. When I say price of the call option or the value of the call option, I essentially mean the option premiums. So this sensitivity is called vega. Delta is the relationship between the underlying price and the option price or the option premium. Vega is the relationship between volatility and the price of the option or the premium of the option. Rho is the relationship between the option price and the risk-free rate. So you can see from the Black-Scholes model that as the risk-free rate increases, as the risk-free rate will increase, the price of a call option will increase. As the risk-free rate increases, the price of a call option will increase. Why is that? Because e raised to power minus r is coming in the denominator. So as this quantity, as r increases, this whole term will decrease. So less will be subtracted from the total. So less gets subtracted from the total, hence the value of a call option increases. You can imagine other way also, if the interest rates are high, that means stocks are also expected to perform well in the future, because stock returns should at least exceed the risk-free rate of return. So as rates increase, so does the value of a call option, and the value of a put option will decrease. You can see from the put call parity, as rates increase, this term will decrease. So less will be added to the price of a put option. This sensitivity is called rho. It is positive for call options, it is negative for put options. That is, as the risk-free rate increases, the price of a call option will increase and the price of a put option will decrease. Theta is the sensitivity of the price of an option to the passage of time. Please remember, as time passes, the value of all options decreases. Very close to maturity, the value of an option becomes 0. So imagine at the moment I give you an option that buy the stock for $10 anytime in the next 1 year. Or sell it at 10 anytime in the next 1 year. And the next case is buy it for $10 anytime over the next 1 week. Or sell it at 10 over the next 1 week. Which option has more value, or which do you think will you prefer, 1 or 2? In the first case you have an option for the whole year. In the second case you only have an option for 1 week. So as the time to maturity reduces, or as time passes, the value of all options decline. So that is the sensitivity represented by theta. Theta is the sensitivity of the price of the option with the passage of time. So please remember this table. Delta is the sensitivity of the option price to the movement in the underlying. As the underlying price increases, the value of a call option increases and the value of a put option decreases. As the volatility increases, the price of both options increases. As the risk-free rate increases, the price of a call option increases, the price of a put option decreases. So it's negative sensitivity to put options. As the price or as the time to expiration comes closer, or as time passes, the value of both options decreases. As the exercise price goes up, the price of a call option becomes lower. As the exercise price goes up, the price of a put option goes up. Why? You can sell at a higher price. So the value of this option goes up. You'll have to buy, but you'll have to buy at a higher price. So the value of this option goes down. So delta, remember, is the change in the value of an option for a 1 unit change in the stock price. Remember the definition? The change, there is no percentage change here. It's not like duration. It's the absolute change in the price of an option for a 1 unit change in the price of the underlying. So let's solve it. During the last 10 minutes of trading, call options on Comart Incorporated common stock have risen from $1.2 to $1.6. Shares of the underlying stock have risen from 51.3 to 52.05 during the same time interval. Calculate the delta of the call option. Calculate the delta. So what is the change in the stock price? Stock price has moved to 52.05 from 51.3. So the change in the stock price is 0.75. So for a 0.75 units change in stock price, the option has changed by 0.4. So for a 1 unit change in stock price, what will the change in the option price will be? It will be more than 0.4. It will be 0.4 upon 1.75. So this is how you compute the delta of an option. So it comes out to be 0.5333. That means for a 1 unit change in the price of the underlying stock, the price of the option will change by 0.533. Just understand what we computed as ND1. ND1 is also the delta of a call option. Okay, just remember this relationship. If I compute ND1, it will also approximately come out to be 0.5333. ND1 is the delta of a call option. Delta of a put option will be ND1 minus 1. It's negative. For put options, delta is negative because as the price of the underlying goes up, the value of the option comes down. ND1 from the BSM model is 0.58. Calculate the approximate change in price of a call option if the stock price is increased by 0.75. The stock price increases by 0.75. For a $1 change, the option will change by 0.58. So 0.75 change, it will change by 0.75 into 0.58. So that's the definition of delta. ND1 is also the delta. You just need to know this. So this is how the value of an option will move. That is, as the option becomes more in the money, so the x-axis here is the stock price, the y-axis is the payoff. As the option comes more in the money, the value of the option increases. So the straight lines that you see in this graph are the intrinsic value of the option. That is, how much in the money or out of the money are we? So if till the time the spot price is below the exercise price, the intrinsic value is 0. But the option will still have some time value, or the option price will still be positive, representing the probability that the option can come in the money in the future. If the stock is already in the money, as on the right side of this graph, then I have some payoff. However, there is a probability that the option can come more in the money. There is a probability that the option can come more in the money as time passes. However, as the stock price increases, the price of the option will increase by delta amount. Just remember, delta is like duration. Delta is a linear estimate. It does not account for convexity. So delta of an option itself changes. Delta for a call option does not remain constant at all prices. As the stock price changes, the delta itself changes. So for large changes, delta will only be an approximation. We need to also consider something called as gamma of the stocks. Now guys, just understand, if an option is deep out of the money, for deep out of the money call options, the delta is close to 0. So the current stock price of Comnet is $60. Call and put options with exercise price of $100 are currently trading. So is the call option in the money or out of the money? Deep out of the money. For a put option, it is deep in the money. Most likely it will be exercised, that is, I'll sell it at 100 and buy the stock at 60 from the market. The call option will not be exercised. Now, if the stock changes from 60 to 61, what happens to the payoff on the call? Does it matter much? At 60 also it is out of the money. At 61 also it is out of the money. So for a call option or deep out of the money call options, delta is equal to 0. For deep in the money call options, delta is equal to 1. I will explain this in a minute. And for at the money calls, delta is approximately equal to 0.5. Now let's understand for a put option first. Same thing happens. 60 goes to 61. What will happen to the payoff on the put option? Will the payoff decrease by $1? Earlier, how much was I getting? I could sell it at 100 and buy it at 60. Now I'll get only 100 minus 61. So for a deep in the money put, delta is equal to -1. That is, as the stock moves up by 1, value of put falls by 1. This is the exact same explanation for deep in the money calls, why they are +1. Similarly, deep out of the money puts will have a delta equal to 0, and at the money puts will have a delta equal to -0.5 approximately. You own $60,000 of Arthral company common stock that is currently selling for $50. A call option with a strike price of $50 is selling at $4 and has a delta of 0.6. Determine the number of call options necessary to create a delta neutral hedge. So if a portfolio is delta neutral, what it essentially means is that even if underlying price changes, portfolio value should not change. So even if asset price changes, portfolio should not change. That's the meaning of creating a delta neutral hedge. So let's see how we can do that. At the moment, what is the portfolio? It is 60,000. It is 60,000 shares. If the stock price falls by $1, what will be my loss? $60,000. At the moment, if the asset price changes by $1, then my portfolio will lose $60,000 because I have 60,000 shares. However, the call option will lose how much? Call option will lose $0.6. So let's say I also buy X call options. So along with the 60,000 shares, buy X call options also. As the stock price falls by $1, the value of this portfolio will fall by 60,000. The value of these call options will fall by 0.6. So this will be the total change in my portfolio. If the stock moves down by $1, will this be the total change in the value of the portfolio, assuming I had also bought X call options? Now the total change in the value of the portfolio for a delta neutral hedge should be 0. So can we compute the value of x minus 0.6x is equal to 60,000? So x will come out to be equal to minus 60,000 upon 0.6 or minus 100,000. That means you should short, I said buy X options, you should sell 100,000 call options. Sell 100,000 call options to create a delta neutral hedge. Why? Because when the stock falls by $1 or your portfolio loses $60,000, the 100,000 call options will gain $60,000. Now, even when the stock goes up by $1, not only does it limit your downside, the problem is this will limit your upside also. In a normal case, a $1 increase would cause a gain of $60,000. However, you are also short 100,000 of call options, which will lose $60,000. So total change, regardless of whether the stock price increases or decreases, in the value of your portfolio will now be 0. This is called a delta neutral hedge. Just like convexity needs to be added to the delta duration estimate in the case of bonds, we need to add the gamma estimate in the case of options. So delta is a linear estimate. It ignores the convexity in the relationship between the asset price and the value of a call option. The relationship is not linear. Delta assumes a linear relationship. That is, if stock price changes by 5 units, the option will change by 5 into delta. Actually speaking, it does not exactly happen like that. There is a curve in the payoff. So you need to add gamma to the delta estimate. Gamma is positive for both call and put options. Gamma is highest for at the money options. So the option is at the money, the gamma will be highest, and gamma represents the change in delta for a change in the underlying. Gamma represents the fact that delta itself changes. Delta measures the change in the value of the option. Gamma represents the change in delta. It is like convexity. Gamma is positive for both call and put options. Now guys, just one thing that you need to remember about the Black-Scholes model. Do not convert or do not compute the returns in a holding period manner. Rather, compute the returns in a logarithmic fashion. Okay, so if a price of R1 has become R2, then this is how we normally compute our returns: R2 minus R1 upon R1. For inputs to the Black-Scholes model, compute the returns as the natural log of R2 by R1, or compute the return as R2 is equal to R1 e raised to power R, assuming there is one period, such that R will come out to be equal to ln of R2 by R1. So we use continuously compounded returns first thing. Okay, use continuously compounded returns. Then you can compute the standard deviation for input to the Black-Scholes model in the same manner. Standard deviation is simply the average of the square of the deviations, which is the variance. Take the square root of that. So take the deviations, take the square, sum it up, take the square root of it to come to the volatility that we will use as an input into the Black-Scholes model. So Black-Scholes model requires volatility. How will you compute the volatility? Use the historical returns and compute the historical volatility of the stock price or the asset price that you are valuing. Okay. Now, just like in the real market we have stock prices which keep fluctuating, in the option market we actually have the call prices or the premiums fluctuating. So with every passing moment, depending on the views of different market participants, the premiums of call and put options keep fluctuating. If I'm given the call price, if I'm given the stock price, given the strike price, the time to maturity, the risk-free rate of return, then from the Black-Scholes model, can I compute the volatility? I can put all these values in the Black-Scholes model, and the only variable left which I haven't inputted will be volatility. The volatility that I compute in this manner is called implied volatility. Okay. Now, implied volatility has many uses and many applications developed on it. We will study that in a later session, but just understand, implied volatility is calculated from the Black-Scholes model by giving it all the other inputs except the implied volatility, or except the volatility input, and the calculated volatility will hence be called the implied volatility. If you are to value the call option and compute C, then you can input the volatility as computed by the historical returns. Just take the average, take the deviations and compute the historical volatility. But if you know the call price, then you can compute the implied volatility or the implied riskiness of the market using the Black-Scholes model. So that's about the first part on derivatives, and we'll do the next part in the coming video. Thank you.